Well, let's turn now to the credit markets. The John Hancock Strategic Income Fund is a top performer and a Bloomberg Best global bond fund. It has offered investors double-digit returns in the last couple of years. Dan Janis is a senior managing director with Manulife Asset Management. He manages the fund and oversees about $10 billion in assets. Dan, welcome to Fast Forward. It's a pleasure to have you. We do focus quite a bit on the credit markets here, and certainly over the last couple of weeks, we've had to wonder, where are people putting their money at this point? It's hard to find value because much of the bond market has performed so well.
Yeah, we still, we like high yield still, and I think I've said this the last time I was on. We're not in the first inning, we're not in the last. I think we're in the six and a half inning, where now you have to clip a coupon roughly between 6.8 and 7.2%, and you get a little bit extra if you in the right part of the cap structure. So that's a place.
So let me break that down a little bit, because the debt markets are not always easy for everyone to understand, and I want to talk about high yield. There's a wide range of high yield. So when you say you want to clip a coupon of 6.8 to 7.2%, you're saying that's the actual coupon on the issue itself. Where do you find them in the credit structure? So are you looking at very low very low high yield rated debt, or are you looking at sort of stuff that's right under that investment grade level?
Well, we can play the whole gamut. That was more the average spread. And I think it's a case-by-case basis depending on the credit fundamentals that our research department would present us. And you can get coupons varying from 6 to maybe 11, but on average it's somewhere around 7. But I think our job is to do our homework, be in the right part of the capital structure of the company, and then monitor it as we see, the earnings and new news come out, and then if we feel it becomes dear, we dispose of it. If we feel there's a new deal opportunity, we may switch that to a new opportunity.
Typically, how long do you hold on to a bond?
Probably over a cycle, maybe a year to 2 years.
A year to 2 years.
In that cycle, and if we really like the credit and nothing changes, then it could be longer. But at certain points in time, you're dealing with leveraged companies, so you are going to have some red flags come up. And then if they do change outside of our expectations, then we're faster sellers.
Now, you also have, this is a global bond fund, so you are paying close attention to world events. Tell me, when you hear about what's happening in Italy, we're still waiting for this press conference, does that make you think there might be some good buying opportunities over in Europe at this point? We've really seen spreads widen out in that region.
Very interesting area. 3.5 years ago, we made a conscious effort not to own any of the peripheral Europe, just because we wanted to use the foreign bucket as a high-quality sort of anchor in our portfolio. The opportunity now, there may be some value being created for us now, but I feel I don't have an edge there. Until I get better information and feel that we have a better risk-reward profile with a more concrete plan of how they're going to address their problems, then I feel I'll have a better chance to get in. But right now, I'm avoiding that area.
All right, and very quickly, we got about 2 seconds here. Emerging market debt, is that also a place you're looking for?
We like emerging market debt, especially in Asia where the growth is. We feel we get a coupon relative to treasuries that gives incremental yield and potential currency kicks with the positive fundamentals there.
All right, Dan, we got to leave it there. Thank you so much for joining us. Great to have your insights looking at the global bond market. That was Dan Janis, portfolio manager for the John Hancock Strategic Income Fund.